In 2019, one company went from being valued at nearly $47 billion to almost collapsing overnight. It wasn't a new technology that failed. It wasn't a global market crash. It was one decision that exposed how fragile the entire business really was. This is the story of WeWork, how it was built at record speed, and how it nearly lost everything just as fast. WeWork started with a simple idea. Instead of companies signing long and expensive office leases, they could rent flexible workspaces that were fully serviced, beautifully designed, and ready to use immediately. The idea spread quickly. Startups loved the flexibility. Large companies liked the modern spaces. And investors saw something even bigger. Within a few years, WeWork expanded into dozens of cities around the world. It leased massive buildings in major business districts and filled them with shared offices, meeting rooms, and open workspaces. But WeWork didn't describe itself as a real estate company. It described itself as a technology company that was changing how people worked. That distinction mattered. Technology companies are valued differently. They are expected to scale faster, grow larger, and dominate entire industries. As a result, money poured in. By 2018, WeWork was everywhere. Its growth was celebrated, and its founder was widely seen as a visionary. At its peak, the company reached a valuation of nearly $47 billion. But beneath the surface, the numbers told a different story. WeWork was losing money. The company signed long-term leases that lasted many years, but rented the spaces out on short-term agreements. That meant fixed costs stayed high, even when demand fluctuated. Growth covered those losses. New funding hid the risks. As long as investors kept investing, the business appeared unstoppable. Then WeWork made a move that changed everything. The company decided to go public. When the paperwork for the initial public offering became public, investors finally saw the details. The financial losses were clear. The business structure raised concerns, and governance issues were impossible to ignore. Confidence disappeared almost overnight. What had once been seen as bold ambition was now viewed as reckless expansion. Within weeks, the company's valuation collapsed. The planned public offering was withdrawn. What was supposed to be a celebration became a crisis. Without the public offering, WeWork suddenly needed emergency funding just to survive. The company downsized rapidly, projects were canceled, leadership changed. A business that had been marketed as the future of work was now fighting to stay alive. The problem was not the idea of flexible offices. People still wanted them. The problem was that growth had been prioritized over sustainability. Narrative replaced discipline. Valuation replaced fundamentals. Speed replaced structure. The lesson was simple, but costly. Building fast is not the same as building strong. And when reality finally catches up, even a billion-dollar empire can unravel. This was the story of WeWork, built at record speed, and then nearly lost just as fast.